Welcome to the Investing Insights podcast from Morningstar.com. Christine Ben's Portfolio Makeover Week is coming this fall. To be considered for a portfolio makeover, email portfoliomakeover@morningstar.com. Include your age, life stage, and some details, concerns, and goals for your portfolio. This week on the podcast, the Fed hiked interest rates this week, and we think banks are fairly valued. David Blancett says targeting a specific date to stop working may not be an ideal strategy. Coke versus Pepsi dividends. American Beacon SGA Global Growth is on our radar. Wide-moat Mondelez looks undervalued. And Jon Hale on his takeaways from recent ESG conferences. Let's get started. Here's our take on the Fed's action this week.
As expected, the Federal Open Market Committee voted to raise its target rate range on Wednesday. The vote was unanimous as economic data remains positive for the U.S., with unemployment remaining quite low, household spending and business investment remaining constructive, and real GDP growth expected to be above 3% for 2018. Notably, the committee removed language from the statement about the stance of monetary policy being accommodative. This suggests to us that the Fed is getting closer to what it views as a neutral rate in the current environment. Still, the market is expecting another hike at the December meeting and 2 more next year. In terms of the impact on the banking sector, the most rate-sensitive names we cover are Comerica and M&T, but we believe that the market largely understands this and view the names as fairly valued. Instead, we see value in Wells Fargo, given the pessimism and poor headlines continuing to plague the bank. Further, with banks in general simply treading water for 2018, we're beginning to see our broader coverage universe as more fairly valued than we did at the start of the year.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, David Blancett on his research into planning for retirement.
Christine Benz from Morningstar.com. Many investors plan to retire at a very specific date, but that might not be ideal. Joining me to share some research on that topic is David Blancett. He is head of retirement research for Morningstar Investment Management. David, thank you so much for being here.
Thanks for having me.
David, you recently wrote a research paper where you looked at retirement dates and how setting a very specific retirement date might not be an optimal way to approach it. But let's start by talking about why delaying retirement can be such an attractive fallback plan. Because increasingly people have heard if you wait a few years even, it can be really impactful in terms of the sustainability of your plan. What's the appeal from a financial standpoint of waiting?
Right. As you made the point, delaying retirement is like the best thing you can do to improve your retirement outcomes. And it does 4 things. It gives you 1 more year to save for retirement, 1 more year for your assets to grow, 1 less year to plan for retirement, and 1 more year to delay claiming Social Security. And the problem is the reverse is also true. So if you retire early, it can really negatively affect your retirement outcome.
Well, that's the thing, and that's one thing that you looked at in this research is that people might feel that they have some level of control over when they retire, but they might not have as much control as they think. What kinds of things can get in the way of someone retiring at a specific date?
You name it, right? So, I think like the big ones are things like healthcare and layoffs. And when I looked at this, I was looking at someone who's, say, 10 years away from retirement. So they make their forecast and retire at age 65. And then things happen. And for the most part, though, when things happen, they require someone to retire early, and it may be 2 or 3 years early on average. And that really affects their outcome, because if you're planning to age 65, you retire at 62, retirement becomes a lot more expensive.
Right. So you looked at some research. Where did you find this research about how retirees' desired retirement dates can be in conflict with their actual retirement
So there's
dates?
a great data set called the Health and Retirement Study, and it tracks people over time. Because what you actually need is someone to say, if they're 55 years old, I'm going to retire in 10 years, and then come back 10 years from now and see when they actually retire. Because what you don't want to do is look at data after someone's already retired, because people adjust their expectations over time, things happen. What you want is someone to kind of give you that estimate and then check back in the future, see how that actually panned out.
Okay. So one thing that you looked at in the research was you attempted to identify whether there were any commonalities as to what might cause someone to retire earlier. What did you find there? Did you find any predictors?
I found a few things. I looked at 20 different variables. And
Okay.
again, so this is at say age 55. So I'm 55 years old, I'm making a guess 10 years into the future. And there are a few things looked at like job stress, physical labor, income, total household assets. And I thought
gender,
all these different variables. But the thing was that got me was that the expected age of retirement was the number one driver, hands down. Other stuff mattered a little bit, but when you expect to retire is the predominant driver of when you actually end up retiring.
Okay. So, though, if I'm not supposed to hinge my whole retirement plan on this desired retirement date, I say, well, 67 is really when I plan to hang it up. What should I do instead? If creating my whole retirement plan around a very specific date isn't a great idea, what are my alternatives?
I think you have to pick an age, right? And so what I found in the research is that people who retire or target age 61 retire at age 61. Those that retire or target retirement before 61 retire a little bit later. So if I said retire at 59, I retire at 60. What gets interesting though is past age 61, you retire earlier and earlier and earlier. So about a half a year for every 1 year past age 61. So the average person that said age 69 is their retirement age retired at 65. And so you still have to target an age for retirement.
Right.
The key though is saying, well, what if? Okay, so maybe I say I'm going to retire at age 67. What happens if it's 64? How does that impact your overall retirement plan?
So make sure that your plan includes a contingency plan. And in the paper, you argue that planning to save more is one way to potentially be a contingency plan.
Right, and so a lot of advisors run what's called a Monte Carlo analysis, and they treat returns as random. They say that, returns can go up by 20%, down by 20%. Well, retirement age is kind of random as well. And so one thing you can do is look at different ages, and to your point, the one kind of solution here is to save more for retirement. A lot of folks don't want to do that.
Or hear that, right.
Or hear that, but that's really all you can do to prepare for that possibility.
Okay, interesting research, David. Thank you so much for being here to discuss it with us.
Thank you.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next, 2 refreshing dividend plays.
Coca-Cola and Pepsi pay some of the most attractive dividends in the beverage space, yielding north of 3%. Both companies have an impressive track record of returning cash to shareholders, as evidenced by a dividend increase each year for more than 40 years. Longer term, we expect both firms to post average dividend growth around 7%. This implies a roughly 65% payout ratio for Pepsi and a 75% payout ratio for Coca-Cola. Further, despite the fact that both firms made sizable acquisitions in August, with Pepsi acquiring SodaStream and Coca-Cola acquiring Costa, we expect them to remain committed to their dividend and continue to view their capital allocation policies as prudent. We think Pepsi and Coca-Cola have secured wide economic moats, thanks to their brand intangible assets and a cost advantage over their peer set, which should ensure that their returns on invested capital remain strong. Pepsi has $22 billion brands in the beverage and snack categories, which have helped it form entrenched relationships with retailers that rely on leading brands to drive inventory turnover. Similarly, Coca-Cola possesses substantial brand equity and an unparalleled distribution network, as its trademark offering is one of the most recognizable global beverage brands. In addition to the attractive dividend yield, we view shares of both names as slightly undervalued, which could provide an attractive entry point for investors. Shares of Coca-Cola trade at a 6% discount to our valuation, while shares of Pepsi trade at a 7% discount.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now, we think American Beacon SGA Global Growth is worth watching.
American Beacon SGA Global Growth features a seasoned management team and is on our radar. Co-managers George Fraze, Gordon Marchand, and Rob Rohn of Sub-Advisor Sustainable Growth Advisors focus on established large-cap firms they believe have strong levels of cash flow available to shareholders, a conservative variant of free cash flow. The three have overseen this fund since its December 2010 inception, and they've built a solid long-term record deploying similar stock-picking techniques at Jon Hancock U.S. Global Leaders Growth. The managers here invest with conviction, typically stashing 1/3 of the portfolio's assets in its top 10 holdings. They pay little attention to the MSCI Equity Index. Notably, the fund tends to have a heavy emerging market stake. Since its inception through August 2018, the fund beat the index by more than 3 percentage points annually. Its above-average emerging markets exposure has resulted in higher volatility than the bogey, but the fund still outperformed on a risk-adjusted basis due to management's quality focus. Fees are above average relative to peers, but have come down as assets have grown. We think this fund is worth watching.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, the new Mondelez CEO is putting the firm back on track to accelerate sales growth.
After 9 months at the helm, Mondelez's new CEO, Dirk Van de Putte, has finally provided clarity as to the direction the firm is slated to embark upon and the gains he believes are likely to ensue from these plans. As we've surmised, the firm's top priority hinges on igniting its sales trajectory, but the means by which it intends to do so are multifaceted, with management looking to extend the distribution of its fare into untapped regions and channels, while also focusing investments behind its core brands, which have been posting outsized growth. Based on these initiatives, management aims to post 3% plus sales growth longer term, which aligns with our forecast. But we never believed Van de Putte and his team would opt to reignite its top line at any cost. Rather, based on his tenure at privately held McCain Foods and his recent rhetoric, we suspected he would opt to put the firm on a path to drive sustained, profitable growth. While management was reluctant to quantify its cost savings objectives, we see an additional $1 billion in excess costs that it could remove on top of the $1.5 billion realized over the past several years, primarily by extracting further complexity from its operations, including rationalizing its suppliers, parting ways with unprofitable brands, and continuing to upgrade its manufacturing facilities. And in line with our thinking, management stressed that a portion of any savings realized would fuel additional spending behind its brand mix in the form of both R&D as well as marketing, supporting the intangible asset that underlies its wide economic moat, which we view as prudent. We expect Mondelez is on a course to drive accelerating sales growth while also posting margin gains over the next several years, and think that investors should feast on shares, which trade at around a 15% discount to our $52 fair value estimate and the high teens to low 20s price to earnings multiple of its wide-moat peers.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
And finally, Jon Hale discusses the Sustainable Investing Conference at the UN.
For Morningstar, I'm Jeremy Glazer. Today I'm joined by Jon Hale. He's the Director of Sustainable Investing Research here at Morningstar. He recently had the chance to attend a few conferences on sustainable investing. He had a few big takeaways. Jon, thanks for joining me.
My pleasure.
Let's start with the way that advisors talk to their clients about sustainability. We've discussed in the past how this is of growing importance to many clients, but sometimes advisors don't quite know how to grapple with that. What did you learn about the way that sustainability should be talked about?
Yeah, well, so it was at the Sustainable Investing Conference at the UN last week. It was a very interesting conference because it was at capacity, 600 advisors. There's so much interest out there among advisors, I think, in how to incorporate this into their investment process. And what we heard at that conference, we heard from Morgan Stanley, who was saying that, in their surveys of individual investors, they're getting, a huge number, 75, 80% of investors saying, yeah, I would be interested in sustainable investing, but advisors are saying, well, I'm not hearing that necessarily from all that many clients. Most of them are saying more are asking about than in the past, but I'm not getting this overwhelming response. And one of the takeaways from the discussion there was that what advisors might need to do is bring it up themselves, because a lot of investors who may be interested, may not be so interested and especially so well informed about it that they feel like it's something they can bring up with an advisor. So if an advisor can elicit that support for sustainable investing by bringing it up themselves, then they're starting to forge a link between themselves and their client. It potentially can make the client a better investor themselves because it's a more meaningful set of things that they're doing with their investments, and it's all for the good. But to expect that 75-80% of investors are going to just sort of proactively bring it up is probably not realistic.
Another takeaway is more on the asset manager side, and that we're seeing a lot more of kind of mainstream asset managers be more interested in ESG investing.
Yeah, it was very interesting. We saw at the Principles for Responsible Investing is a organization originally UN backed, started 12 years ago. It now has 2,000 signatories, asset managers and institutional investors. And their annual global conference in San Francisco last week oversubscribed, record number of attendees. And the thing you noticed there was that there's so many asset managers we would consider to be conventional asset managers. One of the main sponsors was MFS, lead sponsor. PIMCO was all over the conference. And what these conventional investors have done basically is they have incorporated ESG into their investment processes. So it's very interesting to see the various ways in which they're doing that. They're not necessarily, relabeling strategies as ESG outcome-oriented strategies, but they are routinely incorporating it into what they do. And then, in addition to that, they're increasingly interested in, what we call impact investing. What is a PIMCO? And Scott Mather was there on a couple of panels, and really saying, here we're over $1 trillion asset manager. What is the overall impact of the investments that we make on some of these broader issues? And so the UN 2 years ago backed a series of what they call sustainable development goals that really are starting to serve as a framework for investors who want to sort of better evaluate what the impact is on their investments. And so we're seeing a lot of asset managers move in that direction.
Do you think that impact piece will eventually become bigger than thinking about ESG, environmental, social governance, kind of being that granular, and people will think you're kind of in that bigger picture? How do you see that playing?
I think that it's another dimension of sustainable investing. One is focusing on your investment process on using ESG criteria to help you be a better investor on the one hand, but then also this idea of impact I think is very resonant with investors of all stripes, because when you think about it, like all investments have some kind of impact, and on the whole, if you can, orient your investments towards a more positive outcome, then not only do you have success financially with your investments, but you're actually helping literally make the world a better place. So I think that's something we're going to see more of going forward.
Jon, thanks for the report.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.